Okay, hello everyone, and thank you for joining us for our financial webcast presented by Legend Financial Advisors. My name is Dan, the moderator for the webcast. Today's webcast is Ukraine and the State of the Financial Markets with Q&A with Jim Holtzman. Today's webcast presenter is Jim Holtzman, CFP, CEO, President, and Wealth Advisor of Legend Financial Advisors. Please hold as I turn it over to Jim.
Okay, great. Thank you, Dan. And thank you, everybody, for attending today. I know the markets have been very choppy, to say the least, and that even began before the situation really erupted in Ukraine. So my goal today is just to give an overview on a handful of items that what's happening in the markets at this point. We'll also talk a little bit about what we're doing in the portfolios and what's working in the portfolios at this point, and some of the areas of the markets in general that aren't working, to give you an idea of how the portfolios are situated right now. So this, in terms of the discussion about the portfolios, we have a lot of our clients attending today, and the discussion is going to be general to a point, but the areas that we're talking about will apply to most portfolios in various fashions. An example would be if one of our clients has a 40% equity, 60% bond portfolio versus a 70% equity and 30% bond portfolio. The investments, for the most part, are going to apply for both portfolios. The percentage that's invested will certainly be different. So some things might not directly apply to your portfolio, but we want to give you an idea of what we're looking at this point in time. And just to take that a step further in terms of our investment committee, as we always have been doing, is meeting daily, going over the investments on a daily basis, talking through strategies going forward, going through different scenarios as far as what could happen in terms of the situation in Ukraine. Also, even before that situation really became front and center toward the end of February, we were in a situation where we've been seeing increasing inflation. The Federal Reserve has been talking about starting to really slow down their stimulus program as it relates to interest rates. So there are a lot of things already happening heading into the new year. Some of those things caused the markets really to go off to a rough start in the first place. So that's going to be really the main objectives. I will take questions and answers at the end. I'm not going to be talking about any specific client portfolio issues, of course, on that. But if you have questions once we get through this, I'll be happy to have a call, or one of our team members will be happy to have a call to talk about some of the issues further, more specifically as it relates to you. And also, too, if we do run out of time based on the number of questions and answers, I will be absolutely addressing everybody's, even if it's after the webcast is over. Excuse me. So with that, let's take a look at this first slide. So it's titled Geopolitical Events, and this one, it's a little bit dated. It was from 2000, but it had a lot of really good information about 2020 that is, really good geopolitical events that have happened and what the impact has been on the markets. So the first thing, and you can see it's quite a list of these, and we're not going to go through every one of them, but it covers the event date, and then it relates it over to the S&P 500. It shows a one-day drawdown in terms of what that looked like, but then it also showed a total drawdown in terms of high to low during this particular period of time. And the first one you'll see was from 2020, and this chart was created during that time frame. That's why there's no end point. But I thought the historical references were really good to look at and understand how the markets have reacted during different events. It goes all the way back to basically the beginning of World War II with the Pearl Harbor attack. And then the rest of it shows the calendar days to the bottom in terms of the high to low period, but then also how long it took for recovery purposes. And really the main thing on pulling this kind of information together is that geopolitical events certainly have an impact on the market, even if just quickly like eyeball all the different drawdowns, high to low. Some aren't as significant as you might think. Others are more significant. So the thing that we're watching right now as it relates to the situation in Ukraine is going to be, with the markets start to turn around, what kind of a recovery time would it take? And you can see the recovery times are a little more varied in terms of what they've been, but there's clearly a correlating factor of the bigger drawdowns have the longest recovery period. And that's why for our clients' portfolios, we've always had such a focus on minimizing that total drawdown, because ultimately on the way back up, it allows you to have a quicker recovery time. So in really this case, the biggest drawdowns were surrounding 1950, North Korea invading South Korea, certainly the Pearl Harbor attack. Iraq's invasion of Kuwait was basically the second worst drawdown, and then the 9/11 attacks was certainly a big drawdown factor. Some of the research in terms of what we've been reading, geopolitical events, while they clearly cause short-term volatility, for the most part, don't tend to last too long as it relates to the markets. And that's always an important distinguishment. The event itself has an impact, but sometimes the markets recover during the period where the issue that's going on in Ukraine is still developing and getting worse. A really good example of that would even be in 2020, at the beginning of COVID in February and March. The markets fell, historically over 30% in basically 30 days. And then the recovery was just as rapid. But as we know, COVID, in terms of the impact on the country, the shutdowns, was continuing to get worse. But the markets were well on their way. So you always have to be careful from an investing standpoint to not just follow the story. You have to realize, too, the markets will typically lead you out of that downturn that has occurred. So just some interesting information there. It kind of highlights the fact that some of the recovery periods just aren't that long coming out of these situations. So I'm going to scroll down to, on this second slide, this only focuses on 10 to 15% drawdowns. So it's kind of the same information. The main takeaway, again, is that the shorter term time frames are the ones that have the shortest recovery periods. Okay. And then on this particular slide, it's noisy. There's a lot of information. It's just in a way to look at how stocks tend to do after a market correction. And that's basically where we are as far as the S&P 500 goes on a year-to-date basis. The S&P has been in a correction mode. And right now, it's down about 10% year-to-date. The NASDAQ actually touched the bear market mode briefly, being down 20% at one point from a high to low. Year-to-date for the NASDAQ, down almost 16%. So just to pick on a couple of particular time frames here. So we have the high date, the S&P price, the low date, the S&P price related to that, the correction percentage, and then what the 1-year return looked at after hitting that low point, and then the 2-year return after the low point. And the main takeaway is we're not even going to cover a specific date. I just want you to see the corrections are in red. The positive numbers are going to be in green. So when you look at the 1-year return after the lows, it's almost entirely green. Now, the points I will show you are the red numbers. So for this period, and it's a little hard to see the dates, this was related to the technology bubble back in 2000. So 1 year after the low point, as being defined as April 14th, 2000, and it was kind of the first major downturn within that 3-year period. What this is saying is that the S&P was still down at 1 year after the fact. Then another major downturn during that 3-year period was in 2001, and this also ties into the 9/11 terrorist attacks. So 1 year after it dropped 26.4%, it was still down 13.7%. And then the big one is related to the financial crisis from 07 basically to 09. So the 1-year return after the low point was hit was actually worse. And that's because it was really about 17-month period from high to low when things were really difficult. But the other takeaway on this is that for the most part, the markets recovered pretty well 1 year after the fact. Some of the returns are extremely good. And then if you look at the 2-year return, again, it's a lot of green. There are some areas of red still. 2 of those are the same time frames that we've already covered. And there are a couple of other periods where the markets continued to be choppy, but it was really surrounding the different types of major downturns that we've had, 2000, 2007, and even 2020 is really not even showing up on this screen for this purpose in terms of still being red because of the massive recovery that's happened. So, typically with a correction, and some of these are more than a correction, the markets have generally recovered really well 1 year after the fact. So we have to always keep that in perspective, even in these periods where it is very rough roads right now. And just, we've shown the slide before. It just is a refresher in terms of history of declines. And so they're defined as a dip, which is a 5 to 10% drop. And there's been 391 of those in history since the 1900s. The average frequency is about 3 times a year, and the length of recovery is average on 46 days. So here's the correction, the basically we're in for the S&P 500. There's 127 of them over time, about once a year is the average, and then the average length of recovery is 115 days. So I wanted to highlight that because if you separate for a brief moment what happened in 2020 with COVID, we're overdue for a correction. So some of what we're seeing is normal in terms of historical corrections because we're well overdue for one. Granted, the events that are really pushing things right now between Russia and Ukraine are certainly, an extraneous event, a geopolitical event, but sometimes the markets just are looking for that reason to have that correction. And that's the important part about right now is that this is pretty normal in terms of the markets and where we are. Now, obviously that can evolve and that can get worse, but just to put some perspective in it, and along with the charts that we just looked at for the geopolitical events, some of this is normal in that regard. We just haven't had many corrections really since 2009 when we started recovering from the financial crisis. So severe corrections, 15 to 20%, high to low. That's kind of really where the NASDAQ is. The average frequency is about once every 2 years, and the average recovery length is 216 days. So even the NASDAQ, really has been overdue for some type of a correction and even a severe correction in this particular case. Now, the big one is going to be, the next two will be the bear market, which is a 20 to 30% drop. There's been 17 of those. The average is once every 6.25 years, and the recovery time is 11 months. So even in this case, again, if you kind of separate COVID time for a minute because of just how fast the market snapped back, the S&P has been overdue for a bear market. We're not saying that's going to happen in this particular instance, but there is some normalcy in terms of the markets going through periods like this. And then the severe bear market, that's going to be the 30% or more drop. 16 have occurred over history, about once every 8.25 years, and the recovery time is 22.8 months. So the main goal on this slide is just to show you where we are right now. Just talking about the S&P 500 for a moment, it's pretty normal and average, and we're overdue for where we are right now in the market cycle. And then the other thing to point out is then, again, as we deal with the bigger percentage declines, you will see the recovery time continues to increase. So the importance of mitigating the drawdowns so that the recovery time can be shorter, and also too for our clients not having to deal with that type of volatility is obviously very helpful as well. So the next thing is a question that I was getting a lot pre-Ukraine and Russia is related to the effects of inflation. And I just brought in two main points. One, as we all know, certainly at this point, it erodes purchasing power. We're seeing that at the grocery store. We're certainly seeing that at the gas pump at this point in time. There's certainly numerous other areas that we're seeing that in. And then it raises the cost of borrowing because usually what will follow inflationary period is a raise in interest rates, or interest rates going up by market forces, or interest rates going up by the Federal Reserve. So just basic two components of the effects of inflation. There's obviously other ramifications from that. But those are really the two key things to keep focus on. And there are ways, and we're going to talk in a minute about what's working, what's not working, what are areas that can hold up better in these times. So we'll cover that in a little more detail. And, the raising of the cost of borrowing is an issue, again, before Ukraine, Russia, it was a huge focus because of some of the inflation numbers that were coming out. We've been at basically 0% short-term interest rates since the trough of COVID in March and April when rates were dropped to zero. They haven't changed since then. If you draw it back all the way to the financial crisis, we've had interest rates at zero for a majority of that time, which is really unusual. So with the inflation numbers that have really jumped up, the Federal Reserve has basically said they are going to start increasing interest rates this year. The number of times is being debated. 3 times has been talked about. I've seen 4. We've seen that at basically a 0.25% move at each meeting. I've also seen where they might at the first meeting increase it 0.5%, which isn't alarming in itself because it's still very low interest rate. But those are the kind of things we have to keep an eye on. And you will see subsequent rises in borrowing costs from this. So the Federal Reserve controls short-term rates by their meetings and making a decision to raise or lower them. And then they also influence longer-term interest rates like mortgages by some of the different stimulus programs they've run. One of those has been during COVID or after the COVID started, the Federal Reserve really ramped up the purchasing of mortgage bonds and treasury bonds. And basically why they did it is that it lowered interest rates, lowered mortgage rates, and that's why you saw historically low mortgage rates again over the last couple of years. So one of the things they're also going to do is, and they have already started this, is lowering the amount of bonds they're purchasing. And the main takeaway for our clients is to realize that all things equal, that will push up the cost of borrowing with things like a mortgage or a home equity loan, even car loans. We started to see that a little bit. So there's some ramifications that we keep abreast on in terms of the impact of the investments we're using, and we'll talk about that a little bit more. So this is an interesting chart. It's kind of like investment allocation ideas for what other portfolio managers are doing right now, and it deals with what are the typical winners for inflation purposes. I'm going to increase this a little bit, not quite that much. Bear with me one second. And to make this a little easier to read. So the areas that are in red are the areas that typically will not do as well if you're in an inflationary time frame. And you can see EM stands for emerging markets. Cash certainly isn't going to do well because you're going to lose more to inflation than even you're losing now. Healthcare also tends to slow down in terms of performance purposes. The overall bond market is going to struggle typically, and we've seen that over the last couple of years. As interest rates go up, bond prices come down, and for the most part over these last year and a half, that's what we've been seeing. Telecommunications and technology are other areas that can struggle. We're seeing some of that with the NASDAQ so far year to date, and that's also part of the reason why we've been over the last basically year to year and a half, we've been decreasing our technology exposure. We still have technology exposure because it's going to be an important area over the long term, but it's an area that in times of inflation running up, you want to at least control those areas more. Now, the other side of this would be, where do you want to invest? So some of the areas that can do better in inflationary periods are banking, industrial type investments, commodities, materials, equities in general, staples, consumer staples like Procter & Gamble, for example, energy, which is doing amazingly well this year. Part of that is due to the geopolitical events happening. And in general, the Eurozone has been a benefit of higher inflationary times. So these are also some of the things we've been adjusting to over the last 12 months. And even before that, last year we added some banking positions into the portfolio. We also did a shift toward more value investing in the portfolio because that area in general tends to do better in a rising interest rate environment. So we started making those shifts last year. I think it was around May, and we were maybe a little bit early to the game. Interest rates actually went up initially, and then they dropped off towards the end of the year. So some of the benefits didn't necessarily take hold last year because of how unusual interest rates were moving. But now we're seeing, year to date, interest rates have gone up, and some of these areas, while banking is down a little bit this year, it's nowhere down near as much as the markets are. So those are just a couple of areas, just to mention on this slide, of ways we've been shifting the portfolio well in advance of some of this turmoil we've been seeing and the market's reaction to it. We increased some of our exposure to commodities. We have a commodity fund we added to the portfolio relatively recently, and it is doing extremely well. It's so far year to date, it's been performing really well. Part of that, again, is going to be energy, but part of that is going to be related to commodities in general have really started the year very well. We expect that to continue. Energy is certainly an area that has done well. We added into most of our portfolios last year an energy and mining exchange traded fund, and that's in equities, not the actual any type of commodity. And that fund is doing extremely well year to date, kind of defying the odds of where the equity markets have been overall. Those are a couple of areas to point out. Value, again, we added a small value fund to the portfolio last year. Timing was good initially, kind of like banking, with interest rates rising, but then when they dropped off for a period of the second half of the year, value also struggled in that time frame. However, value is holding up really well at this point, and value in general will hold up better with the rising interest rate environment, which for the most part over these next couple of years we do anticipate continuing. So those are just a couple of areas. Other areas that tend to do very well, and some of those areas we've already shifted to at this point in the cycle. And some of the areas in terms of the technology, we've been reducing that exposure. We are talking about reducing some of that exposure further. The bond area, that's another strong point in the portfolio, is a lot of the bonds we are using aren't tied directly to interest rates or having a fixed interest rate. That's where you run into this problem when interest rates go up and bond prices come down. A large percentage of our bond allocation has more adjustable rates. So when interest rates go up, these particular funds and the bonds that they own, the interest rates will go up with the market over time. So as a result, you're seeing good results last year. The Treasury market, I think the 10-year Treasury was down about 6 to 7% last year. A lot of the bank loan funds or floating rate loan funds that we use were up anywhere from 4 to 7%. So that's the benefit of that dynamic in a rising interest rate environment. Then at some point over the next couple of years, maybe it might be that long when interest rates start to really rise, we'll start shifting away from the bank loan funds, not entirely, but maybe in the more traditional bond investing, because that would be a more opportune time to invest. So healthcare, we've had a really good healthcare position in most of our client portfolios over really the last 12 years. The fund is down year to date, which makes sense in this particular case. So it's something we're keeping an eye on. But the healthcare fund has been a really strong performer. The fund we're using has had a really good track record of holding up when the markets fall. So it's just something, we talk about every day, look at every day in terms of how it's reacting. And then cash is another area that shows up in the red because of the fact that if inflation is 8% and cash is earning 0, well, that's a negative 8% real rate of return. However, in the context of our client portfolios, we are carrying a little more cash at this point. And part of that is from the normal rebalancing we do at the end of the year and beginning of the year. Some of the funds will pay out more distributions at year end. We have purposely kept that money in cash as a way to mitigate and control some of the volatility that we're seeing in the markets. Clearly, that's not a long-term position because of what I'm showing you here. But for our clients' purposes, having the cash in the portfolio has benefited because of the fact that almost all areas of the equity markets are down. So the goal will be to put that cash to work, but we're also keeping an eye on this current situation in terms of what's happening in Ukraine and Russia, and just kind of monitoring it from that standpoint, because there's no reason to put money to work in the environment we're currently in with equities falling down. There will be some points, and it could happen even in the next week, where we start to allocate some of that money. But just to give you the mindset of where we've been portfolio-wise. So it's been a couple of things that have really helped. Some of the areas that I pointed out, like energy, commodities in general. I didn't mention gold. Gold is also doing really well, and we have that in our client portfolios pretty much across the board. Gold is not surprisingly doing well in this environment. So gold we put in the portfolios back in around the beginning of 2019 and did terrific in 2020 when the markets were dropping off significantly. Then gold really struggled from around August of 20 until late last year. However, we thought it made sense to keep it in the portfolio, given how it performs during volatile times, and gold's always looked at as a good inflation hedge. And sure enough, gold has really been rebounding and helping to stabilize the portfolio from that standpoint. So that gives you a little bit of a flavor on this chart. More specifically, more importantly, is how it's impacting the portfolios and what we're doing at this point in time. So we're not going to go through all of this. You've seen this one before, most likely. This covers different U.S. sectors, and this is year to date. And I think the main takeaway, without diving into each one of the indexes, here's break even at this point, and you can see everything is basically negative, except the red line is utilities. They're slightly above break even. And then, unsurprisingly, energy is the big winner, at this point in time. But everything else is down as far as sectors go. So it's been a rough start, certainly for the markets this year. And these sectors are what makes up the S&P 500. So that's important. That all contributes to why the S&P 500 is down about 10% year to date. And then this one shows different indexes. Again, most, if you look at the 0% line, most indexes are down year to date, some substantially. What's doing well? Well, this is commodities, again, part of energy, gold, things like that. And then when you kind of go down a little bit further, you have to go all the way down here, where this green line, light green line, is for managed futures. The gold line is gold bullion. And then the green line right here is the U.S. dollar. So it kind of tells the story on why the year has been such a difficult start, even before the Ukraine-Russia conflict really took off. And really, at this point, I want to open up the questions and answers. I think any kind of feedback or questions that I can help address, I would like to take care of that. I do have a couple of other charts and slides I might refer to, but I want at this point really to get to the point of having some of the questions come through. And I'm just going to give this a second and I'll pull up. It looks like so far no questions are coming through. And the other thing too is that as we're talking through these issues, I realize this is a very specific conversation ultimately that we're having with all of our clients about the markets, the portfolio, what we're doing, what's working, what's not working. So, we can clearly, have those discussions. I think that's the most important thing, is talking to each of our clients and addressing their specific needs. The other thing too is that, we push hard in terms of working with our clients and talking about risk tolerance. Many of you have seen our new software called Riskalyze, which creates a risk score. It's for times like these are why we go through those processes, because it's so important to understand our clients' take on how much volatility they can withstand in the portfolios we're managing. That's why the fit is really important initially, and we like to do that in times where they're a little more calm, because you don't want to make decisions in a period like this. But if the decisions are made when the markets are somewhat stable, then it should, ideally, the portfolio will hold up according to each of our clients' risk profile. And I think we've been very successful with that over the years. And that's going to be a process that is going to continue as we evolve it with things like Riskalyze and different ways to have conversations with our clients about the best ways to invest their money. And on that part too, if anybody wants to go through that process again, we'd be happy to do that. And I think we just want to make sure we have it in context with where the market is right now. We have to realize too that the markets are more choppy right now. But if anybody's uncomfortable with the volatility they're seeing, we really want to have that conversation right away to make sure that we're all on the same page with the portfolio we're managing for you. So a question that came in is, if the war continues in Ukraine, between Ukraine and Russia for several more months, what additional adjustments might we make to the portfolio? So if this evolves into something more than it currently is, whether it's other countries getting involved or the war itself continues, I think areas that we would look at for adjusting, we've talked about increasing even the gold allocation in the portfolio. That might be something we do regardless of how that situation unfolds. If this evolves into something more, that's a step we could take even sooner. When we look at our portfolios, we identify each investment in terms of its own volatility. And if we run into a period where the downturn continues and evolves, there are ways we can take the most aggressive parts of a portfolio and either reduce them or take them out for a period of time. We have to be careful doing that because the markets, as we saw during COVID, can snap back really quickly. But at the same point, there can be opportunities where we can kind of pare back some of the volatility in the portfolio as well. And we're clearly seeing, some of the areas that are doing well at this time. If the situation in Ukraine slows down, energy is going to start falling as well. So we have to keep our mind on that piece too. It's also normal in these periods where you will see quick rallies that can happen, in the markets. And we had I think it was 2 days ago, the markets had a really unbelievable day. That certainly helps things, but that doesn't mean that the volatility is over on the downside as well, as we've seen over even the last couple of days. And I know before I jumped on for this webcast, the markets were down again today. So, and that's part of the perspective too. You just don't want to get caught chasing the markets up or down in this type of a situation. We've been very comfortable with how the portfolios have been reacting. And, if this continues, then, if we have to make other adjustments, we will. One more question. And just so everybody knows too, we will make this recording available for anybody that wants to hear it again. Also too, when we put this together over the last week in terms of this presentation, we did this exclusively for our clients. Oftentimes when we do our webcast, we'll open it up to really everybody, including our clients, of course. But given the turmoil that's taking place, given the changes that we've been dealing with at Legend, we thought it was really important to make this exclusive for our clients, recognizing everybody has different portfolios and some things will apply less or more to others. But I think it's important that everybody understands our thinking and what we're looking at right now, because as I mentioned before, our investment committee, we're meeting daily. We're looking at reports every day on how the funds are doing, how the portfolios are doing, obviously looking at the situation geopolitically, and also too where the markets are heading every day, because it's been very choppy lately. So I think, in terms of one of the questions about the rally from 2 days ago, is it a short rally? I think right now you'd have to expect that to be the case, given what's happening overseas and the fact that interest rates are still expected to go up. Now the markets kind of price that part in for the most part, but the effect of interest rates going up is that it could slow down the economy. It's meant to really tamper down inflation. So those are some reasons why the rally that occurred 2 days ago, you can't expect it to continue for a long period. Given the choppiness that we're seeing at this point in time, there's just a lot of factors that probably aren't going to allow a rally to really evolve into much more than a couple of days. We don't have that crystal ball to predict that, but historically that's been the case during geopolitical events as well. And I think it was about 3 or 4 weeks ago. Overall, the markets had a really good week. So it does give you some reasons for optimism, but there's just too many question marks out there that cause the short-term volatility that we're currently seeing. Okay, another question is in regard to do we see cybersecurity as an area to consider for investment? And there certainly has been a pretty major evolution in terms of, from an investing standpoint, getting exposure to cybersecurity companies. There's been some exchange-traded funds that have been created. So with ETFs, they're basically they hold a basket of securities. In this case, it would be specific to the cybersecurity area. So it's an area that we certainly follow, and we don't have in the portfolios at this point in time. But it is an area that is clearly a hot area in areas where you could have companies are relatively new. They can have a really big growth spurt as well. They're also going to be more volatile areas. So part of our job is, as we look for investments, it's also about how we place the investments in the portfolio. And some of the things we do all the time when we're looking at making an addition or taking something out of the portfolio is understanding the effect it has on the portfolio. And when we've gone over and meetings with our clients, the Morningstar reports, one of the reports in there also gives what's called a correlation matrix. And it sort of shows us how each investment interacts with each other. And that helps a lot when you're building the portfolio or maybe making any kind of a change. So with something like cybersecurity, that we run it through that same process if we get to a point where we want to consider that for investment. Excuse me. Okay. There's me. I threw some other questions that have come in. So another question is in regard to possibility of recession forming. And it's a really good question because market downturns tend to be most significant when the economy is in recession or heading into a recession. So this is a big area that we keep a very close eye on. And it's not the technical definition of a recession, but the definition that's referred to the most of being a recession is 2 consecutive quarters of falling GDP. And that's basically growth of the economy. So if you get to 2 quarters where the economy is falling, that's basically defined as a recession. So right now, we don't see imminent signs of a recession forming. Earnings expectations are still pretty strong. Earnings announcements have been pretty strong. We're still recovering economically coming from the COVID downturn. So there's maybe a little more room for the economy to grow than maybe typically at this point in the cycle. So the short term, we don't see that risk. That can change pretty quickly, especially from geopolitical events. So we have to keep our eyes on that. But right now, with interest rates going up, that can cause a recession at some point. It typically doesn't happen with the first handful of interest rate increases, but there is a breaking point where if the Federal Reserve is too aggressive on raising interest rates, it's something like, I think 7 of the 9 past recessions, you can tie that into the Federal Reserve being overly aggressive on raising interest rates. So it's a great question. It's a very legitimate issue that we have to follow. And I think in the short term, though, every indication we're seeing is that a recession really isn't forming at this point. And I think a lot of that is based on just the sheer recovery coming out of COVID still, with businesses opening up even more. You're hearing more about the mask mandates being lifted. That will further open up the economy, but that's still also a issue to follow itself is COVID, and if there's any other variants that form that could cause the economy to shut back down again. I don't necessarily see that happening like we saw in 2020, but those are some things that could change our views very quickly. So we have to be cognizant of that. And, again, some areas of the portfolio would hold up most likely well in that period, gold being just one of those areas to point out to. So that's why we talk about, do we want to add some more gold to the portfolio, just as one example. And there's multiple reasons why we might want to consider that. Okay. Another question was the best one position long-term over the next 10 years. That certainly is, that's a question that'll evolve, or an answer that'll evolve over the next 10 years. But ultimately, some of the best ways to beat inflation are through equity investments. So that's over a 10-year period, that opens up that opportunity. Equity positions can do well over that long of a time frame. So I'm going to answer it more in general. I think having some allocation to equities is going to be really important still. It adds the volatility, but it also helps you beat inflation. So it's a balancing act, and that's why we have the portfolio set up the way we do. That's why we have the portfolio options that we have, is so that it can fit our clients' risk needs, but also their longer term goal objectives. Okay. Another question was in regard to Amazon splitting in terms of the number of shares, and any comments on that. I mean, generally that's being done to lower the per share price on Amazon, which can entice investors to look at it as being cheaper, just because the price also will drop if the number of shares are increasing. So that's generally what happens there, but I can't really comment beyond that at this point, as far as an individual stock goes. But generally, when stocks split, that's part of the reason for that. Okay. I'll wait a few more minutes just to see if anybody else has any questions. And again, I'm happy to talk to everybody directly on their specific portfolios, or anybody from the team would be happy to do that. One of the things, based on a couple of questions that have come in, an important distinguishment as we build out the portfolios is that in what we define as our equity exposure, we do include, as part of the equity allocation, some of the allocations to commodities. So the commodity fund we added, it's really more about the commodity exposure itself. Gold is another example. That fund that we use tracks the price of gold. So it's an important difference when comparing that to, the energy ETF, exchange traded fund that we have, because that's actually investing in equities. There is certainly this year, there's a clear relation to the price of commodities going up so significantly. But sometimes, we build out the portfolios too. The difference between getting exposure to the commodity directly is a much different analysis compared to getting indirect exposure to the commodity through equities, through an ETF or through a mutual fund. So that's an important distinguishment to make. So as we make some adjustments to the portfolio and you wonder, well, they're decreasing in this area but increasing another area, it might not make sense at first, but sometimes the reason could be is that the commodity exposure is just going to be so much different than the equity exposure. And that's all part of what we use to build out the portfolio, running the analysis, looking at the correlation and understanding that. And one of the really neat things when we go through the correlation analysis is that we get to see how well gold does, for example, and how the correlation to other investments is really low. So when I mentioned about correlation in terms of it being really low, that basically means gold is not moving in the same direction on average compared to another investment. So when we have really high correlations between two investments, that means they're going to pretty much move in the same direction. That doesn't have to be a bad thing. You just have to recognize how to read that in terms of how we build out the investment portfolios. So hopefully it helps explain a little bit more between the actual commodity exposure and the equities that might look like it's commodity exposure, but it's more indirect. I'll wait another minute or so and see if there's any other questions that come through. So I think just I think it addresses a couple of questions that have come in too in terms of the portfolio changes. What we try to do and it's always been the position of the firm, and that's why we've been able to do really well in downturns, is when the bigger downturns occur, is, as I mentioned during some of the slides, is really mitigating the downturn that is occurring in the markets. If the market's down 30%, equities for the most part you would expect to be down. But one of the key things that when we're looking at the portfolio is if we can invest in the areas that are much cheaper than the markets, then that's going to help cushion the fall as well. That gets back into the value position, the small cap value position we added, the banking position that we added, just to name a couple of examples. They're equities. They can be volatile, but they're also much cheaper than the market. Value in general right now is at a historic discount to growth, meaning that it's much, or historically cheaper is another way to put it. So that's been part of the reason for some of the shifts we've made. Rising interest rates, again, benefit value investing more so than growth investing. So that's why the shifts we've been doing over the last couple of years, we've been doing that. It's with the eye towards keeping equity exposure, but getting it at a much better price is another way to put it. And then there will be a point, when interest rates are much higher, then you have to start shifting that around again, adding some growth to the portfolio, maybe cutting back the value. And those are the kind of things we do incrementally, over time, so that when we get into a position like this, when the markets are just as choppy as they are, we don't necessarily have to make huge changes to the portfolio because we've tried to get it in a good position to begin with. But as one of the questions earlier came through, what would we do if the war evolves into something more? Well, that's why we also have to have that plan if that does occur. Which investments would we want to pare back, maybe eliminate for a period of time because of the fact that they're more aggressive, could fall more than maybe some other investments. So the more that can be mitigated in terms of not having to make full-scale changes like that, that can be really beneficial. But there still can be times where that's necessary. We did some of that back during COVID. We were able to reduce the volatility in that downturn. But we also didn't want to just change everything because as we saw, the market rebounded really quickly and the portfolios reacted really well. So we're able to lessen the downturn and in this case, in 2020, really participate on the upside. Doesn't always work that way perfectly, but that's the objective, is to smooth the ride out for all of our clients. I think it looks like that's it for the questions. I will go through the questions again and make sure that I addressed everything. If I didn't, I'll reach out to you directly to make sure that the questions have been answered. But feel free, again, we can set up a call. We can go through things in more detail and address any questions from this webcast or anything else that anyone has at this point. So I'm going to leave it at that. I really appreciate everybody registering today for the webcast. I thought it would be a really important way to get some information out about what we're doing at this point in time. And thank you very much. And I'm going to turn it back over to Dan.
Great, thank you, Jim. That was a lot of great information, and I want to thank our clients for joining us today. If you would like to schedule a conference call with a member of our advisory team to cover further information, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.